recently saw you share some charts on a post by Fed guy Joseph Wang about how quantitative tightening impacts the markets, and specifically how in the tightening in 2017, 2018, it was banks owned they put their excess savings via repo because repos earned more than treasuries. Now repo yields less than treasuries, so they're buying treasuries. So that quantitative tightening could actually cause the banks to sell their bonds rather than buy more bonds. So that even though historically over the past 10 years, quantitative tightening has been associated with flattening yield curves, long-term bond yields going down, people selling bonds, it actually could be the reverse this time. What do you make of that theory?
So I think it's a good theory. I think, I categorize it less as a base case and more as a risk factor to watch. It's essentially, I think, one of the potential outcomes from a policy error. And so there's a lot of things that they can do to avoid that issue. They can change the SLR rules. The Treasury can change its debt issuance towards more bills. And so I don't think that's a foregone issue. But essentially, yeah, basically what he's pointing to is that if they do, say, very aggressive, not just say they stop expanding the balance sheet and inflation is still sticky because of the energy supply constraints, and say they want to start doing quantitative tightening, if they get overzealous on that, at the same time as the Treasury market is the Treasury Department, I should say, is not issuing enough bills. They're issuing a lot of coupons, and you could have a policy error that results in a kind of a Treasury market that goes illiquid and spikes, similar to what we saw in, say, the first quarter of 2020. And so I think that's something to watch as because that would probably be very bad for risk assets overall. And so it's something I'm watching around the margins. Um, I think that the treasury market has a couple different levers right now. So the growth deceleration that we're seeing in the Western world should put downward pressure on yields. On the other hand, the stickiness and the kind of the tightness of inflation in energy markets should be, obviously positive for them. And if you look at the absolute level, I mean, the long duration bonds are still well below the inflation rate. And so you'd think that their natural tendency would want to go up to some degree. Now, my base case is that most of the 2020s they'll be submerged below the inflation rate. And so in some ways, my view is towards generally higher inflation and generally lower yields. And I think that's the regime that we're in. But a lot of things can change for periods of time around the margin. And so there are periods of time where I will join my friends over in the disinflation camp and say, I think that as sticky as I think inflation is, I think we could be peaking in rate of change terms year over year, for example. And there could be other periods of time where I think, that the long duration yield are overdone and that we're due for maybe a flattening of the curve. And so the way I interpret his information is that it's something to monitor. It definitely, it basically gave me some charts to watch to observe problems in a similar way that I mean, I think Luke Groman did excellent analysis back in 2019 that pointed towards some of the supply demand mismatch between T-bills and cash, and that culminated in the repo rate spike. I think he had one of the best calls of that year, and it kind of pointed towards areas to watch. And so I interpret the data the same way.